How does a company that's on fire suddenly go up in smoke? A company with lines out the door, opening new stores at a blistering pace with revenues soaring over 20%? How does a company like that watch its stock get vaporized by more than 20% in a single day? This is the shocking story of the CAVA stock crash. And what happened to this Wall Street darling reveals a dangerous trap in the stock market. A fundamental misunderstanding between what makes a business successful and what makes a stock price go up. Understanding this trap is one of the most important lessons any investor can learn. To understand the crash, you first have to understand the hype. Since its blockbuster IPO in June of 2023, CAVA Group wasn't just another restaurant chain. It was a story, a movement. The company's mission was to bring heart, health, and humanity to food. Founded by three childhood friends paying homage to their Mediterranean roots, CAVA wasn't just selling bowls, it was selling a lifestyle. This philosophy resonated powerfully in a post-pandemic world. Consumers were desperately seeking healthier, more diverse, and authentic food options. The Mediterranean diet, backed by decades of health research, was exploding in popularity, with the market projected to grow at 7% annually, reaching $20 billion by 2032. CAVA was the perfect company at the perfect time. Wall Street fell in love. Analysts quickly crowned it the next Chipotle, another fast casual revolutionary that had turned early investors into millionaires. And the numbers backed it up. CAVA was on an aggressive expansion plan, with a clear goal of growing from just over 300 restaurants to at least 1,000 by 2032. And unlike many high-growth startups burning through cash, CAVA was profitable. Its stores were incredibly efficient, boasting industry-leading profit margins and generating high average sales of nearly $2.9 million per location. This powerful economic engine meant CAVA could fund its own rapid expansion without taking on debt, a massive structural advantage. For over a year, the stock was a rocket ship. Investors who got in early were rewarded handsomely. CAVA seemed unstoppable. It was the hero of the modern restaurant industry. Until August 12, 2025, the day the hero stumbled. Earnings season is Judgment Day on Wall Street. It's when a company has to show its report card to the world. On the surface, CAVA's second quarter report card looked pretty good. Revenue was up a massive 20.3% year over year to $278.2 million. They even beat profit expectations, reporting adjusted earnings of 16 cents per share when Wall Street only expected 13 cents. More revenue, more profit. What could possibly go wrong? The answer lies in one number. A single metric that, for a growth stock like CAVA, can mean the difference between soaring to new heights and crashing into the ground. That number is same restaurant sales growth, or SRS. SRS measures the sales growth from stores that have been open for at least a year. It's Wall Street's favorite tool for measuring the underlying health of a retail brand. It strips away the growth that comes from just opening new stores and asks a simple question. Is the core business, the existing restaurant base, still growing? Is the brand still popular? For CAVA, the answer was a resounding, terrifying, barely, a growth of just 2.1%. Analysts were expecting more than triple that number, and it was a catastrophic drop from the stellar 14.4% growth they had posted in the same quarter a year before. To the market, this wasn't a small miss, it was a five-alarm fire. The story of unstoppable growth suddenly had a plot hole. The company also slashed its guidance for the full year, cutting its expected SRS growth from a range of 6 to 8% down to just 4 to 6%. The reaction was instant and brutal. The stock plunged over 20%, wiping out nearly $2 billion in market value. The darling of Wall Street had been cast out, and this is where the real story begins. Was the market's panic justified, or did everyone miss the point? This brutal market reaction is a perfect example of the kind of financial drama we break down here every week. If you're finding this deep dive valuable, do me a favor and hit that like button. It's a huge help, and it tells YouTube you want more analysis that goes beyond the headlines. For the bears, the pessimistic investors, that 2.1% number was all the proof they needed. To them, the CAVA growth story wasn't just slowing down, it was broken. Their argument rests on three powerful pillars. First, the consumer is tapped out. CAVA's own CEO, Brett Schulman, gave the bears all the ammunition they needed, stating that consumers are navigating a fog of economic uncertainty. This wasn't just a CAVA problem. The entire fast casual sector was feeling the pain. Chipotle reported that its same-store traffic declined, forcing them to lower their own sales guidance. Sweetgreen sales were also in a nosedive. Broader economic data confirmed the trend. Consumer spending at restaurants was slowing as inflation and tariff fears made people clutch their wallets tighter. The bears argue that CAVA, with its premium pricing, is a discretionary expense that consumers are now cutting back on. Second, the stock was priced for absolute perfection. Before the crash, CAVA was trading at an astronomical valuation. Its price-to-earnings ratio was over 70, and its price-to-sales ratio was nearly 10. These are numbers you expect from a red-hot software company, not a restaurant chain. This premium valuation meant there was zero room for error. The company had to be perfect. The moment that SRS number came in at 2.1%, the perfection narrative shattered, and the stock price had to come crashing back down to reality. And third, the ultimate red flag. Insiders were selling. In the 6 months leading up to the crash, CAVA executives and insiders sold shares worth millions of dollars with zero open market purchases. The CEO, the CFO, the chief concept officer, they were all selling. To the bears, this is the most damning evidence of all. If the people who know the company best are cashing out, why should anyone else be buying in? For the bears, the case is closed. The hype is over. CAVA is just another restaurant chain facing a tough economy, with a stock price that still has a long way to fall. But the bulls, the optimistic investors, see a completely different picture. To them, the crash wasn't a signal of a broken company. It was a massive, irrational overreaction from a short-sighted market. Their argument starts with a simple question posed by one Stifel analyst. Does a single data point justify wiping $2 billion off a company's value? The bulls say absolutely not. They argue that Wall Street became obsessed with that one SRS number and completely ignored two critical pieces of context. First, the slowdown was predictable and temporary. CAVA was facing a brutally tough comparison to the previous year when it launched its grilled steak, a blockbuster new item that had caused a massive surge in sales. Lapping that success was always going to be difficult. Furthermore, CAVA's newest stores from 2024 were so successful, opening at unusually high sales volumes, that their entry into the same-store sales calculation created a honeymoon effect, artificially dragging down the growth percentage, even though the stores themselves were performing brilliantly. But the second and most important point the bulls make is that Wall Street is looking at the wrong number entirely. The real growth engine for CAVA isn't same-restaurant sales, it's new restaurant openings. This is the core of the bull thesis. While the market panicked over 2.1% growth in existing stores, it ignored the fact that CAVA opened another 16 brand new restaurants in the quarter, on its way to its goal of 1,000 stores by 2032. These new stores are powerhouses, opening with average sales on track to deliver over $3 million a year and maintaining those incredible 26% profit margins. The bulls argue that focusing on the SRS of a 400-store chain that's rapidly growing to 1,000 stores is like judging a marathon runner's pace in the first mile. The real story is the distance yet to be covered, and CAVA is building a technological moat to protect that future growth. The company just announced a major investment in Hyphen, an automation company developing a robotic make line for digital orders. This isn't about replacing people, it's about making the business more efficient. By automating the back-of-house line that handles its massive volume of digital orders, CAVA can improve speed and, more importantly, accuracy, a key pain point for digital customers. This frees up human team members to focus on what they do best, providing that human connection and hospitality in the dining room. It's a strategic, forward-thinking move to protect margins from rising labor costs and build a more scalable, efficient business for the long run. For the bulls, the story is clear. CAVA is a healthy, rapidly expanding company whose long-term growth plan is perfectly intact. The stock market just had a panic attack based on the wrong metric. This battle between the bull case and the bear case, between Wall Street's perception and a company's reality, is a theme we explore constantly on this channel. If you want to stay ahead of these market-moving stories and understand the forces that truly drive stock prices, make sure you're subscribed with notifications turned on. You won't want to miss what's coming next. So, who is right? The panicked bears or the defiant bulls? The story of the CAVA stock crash isn't really about Mediterranean food. It's a perfect case study of what can be called the growth stock maturity crisis. This is a predictable yet often painful phase in a company's life. In the early days, a company like CAVA is judged on its vision and its potential for explosive expansion. The stock price soars on hype and the promise of future growth. But then, it hits an inflection point. The market's focus suddenly shifts. It stops rewarding the company for opening new stores and starts punishing it for not growing its existing stores fast enough. Wall Street begins to judge the adolescent growth company with the measuring stick of a fully mature adult. Fixating on same restaurant sales as the only metric that matters, this is the trap CAVA fell into. The market used the wrong metric for the company's current stage of life. It panicked about a slowdown in a mature company metric, SRS, while ignoring the continued acceleration of its growth company metric, unit expansion. This story is a powerful lesson about the two different markets that exist. The market of business fundamentals, revenue, profit, and customer satisfaction, and the market of stock prices, which is often driven by short-term narratives, fear, and a herd mentality. CAVA's business is fundamentally strong, profitable, and expanding rapidly. Its stock crashed because the narrative that Wall Street had built around it was shattered by a single number. This leaves every investor with a critical question. When the market panics, are you looking at the stock price or are you looking at the business? So, what do you think is the bigger story here? Is the CAVA stock crash a massive red flag about the health of the consumer and the company's future? Or is it a brilliant buying opportunity created by a market that can't see the forest for the trees? I've pinned a comment below with that exact question. Head down there, cast your vote, and let me know why. I read every single one. Thanks for watching.